both the Trump campaign and the Republicans in the House are very close on their two packages. We're going to take the corporate rate from 35% to either 15 or 20. I like 15 better, but it's somewhere between 15 and 20. We'll go to full territoriality so that while they may deem repatriation for some of the money that's overseas and tax it now, it would never be taxed again. We'll become a normal country that taxes things within its borders and doesn't tax income overseas. Also full expensing, which is very important to drop the cost of capital. And I hope that like-kind exchanges will continue. 1031, that's being debated. Until you get rid of the capital gains tax, you really need to have 1031, which doesn't punish you when you trade up from small trucks to bigger trucks or small buildings to taller buildings. You pay capital gains when you cash out, not all the way along.
Jared, there's no way that you can have a problem with any of that. So
End of segment. I'm good with all of that. No, just kidding. Look, I think my usual role at this point in the debate is to say we don't need a big tax cut. In fact, if anything, we're going to need more revenue in the future, whether we're talking about the infrastructure investments we just heard from our friend from Aspen, or whether we're talking about just our aging demographics. But in fact, a tax cut is coming. So what we need to do is think about how we get the biggest bang for the buck. Now, some of what Grover was just saying is going to happen, but there are details that make a difference. So, for example, I'd like any change to be at least revenue neutral, and I would argue for revenue positive, and Republicans are nowhere near there. Now, Grover talked about full expensing. Well, one of the Republican ideas, and I actually like this idea, is to eliminate interest deductibility. You can't do full expensing unless you eliminate interest deductibility, or you're creating a big new tax avoidance loophole. Now, that's a problem for financial and some real estate industries. I also kind of like this destination-based border adjustment idea for the corporate code, but I'd really love to hear Grover say that he would endorse this idea of eliminating interest deductibility, which is part of the Republican plan.
Okay, I'm not sure it's actually necessary to do that. There is a discussion about whether you make it voluntary. Do you want to take expensing and or get rid of interest deductibility? I think expensing, going to full expensing, shortening depreciation schedules to year one is an important first step. I did leave out of our earlier conversation of what was going to happen. We will be getting rid of the death tax, finally, which was put in to pay for the Civil War. That's over. And we will be getting rid of the alternative minimum tax, which was supposed to hit 155 people living in New York and has expanded to millions.
So Grover, can I ask you, Jared brought up this whole destination-based taxation. The retailers have gotten hit recently because of this. If you dig down into the GOP House plan, they don't want to just lower the corporate tax rate. They want to dramatically change the way corporations are taxed. They're not going to be taxed on the profits. There's going to be this value-added tax process that once they export, they can get all that money back, which essentially ends up with a zero tax rate, basically, if you're going to export something. But it seems to be bad for the retailers because they'd have to pay a lot more taxes on everything they bring in. Am I explaining it correctly, Grover, and do you think that's a good idea?
It's not a VAT, because the VAT taxes labor costs as well.
Oh, right. This is just on cash flow, excluding labor. Right.
It's border adjustable for the corporate income tax that you pay. I'm always concerned that that could turn into a protectionist thing. But if our goal is to take the corporate rate from down to 20 to 15 and eventually down to 10, and I hope to 0, because it's just a silly, destructive hidden tax. They pretend somebody other than you, the consumer, pays for it. If you get it down low enough, the border adjustable thing is less of a problem. But it
is a problem for something like a retailer, right?
It is. Can I just, so Michelle, let me just say, Michelle, you explained that very well, I think. It is basically it's a tax on imports and a subsidy on exports. I think there are some attractive aspects of it. It's interesting, Andrew's written about this inversion problem. If you actually go to this destination-based border-adjusted tax, you do take the location decision out of the tax avoidance scheme.
Yeah, you eliminate that problem.
But wait, one thing I just want to say, Grover and I strongly disagree on this business of eliminating the estate tax. He calls it the death tax.
Right.
Look, this applies to 0.2. This applies to 0.2% of estates. The exemption right now is over $10 million
So why have it
for
at
a
all?
couple. So because it actually raises some significant revenue, and because if we don't have it, there's a bunch of income that goes untaxed.
Right.
So it's just a pure gift for the wealthiest of the wealthy, and I think it's really not a smart idea.
Okay.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.